You know what's wild? You've been sitting on the sidelines of the housing market for 3 years because mortgage rates have been absolutely brutal. And then you wake up one morning to see mortgage rates dropped below 6% for the first time since 2022. And the reason? The government just announced they're buying $200 billion worth of mortgage bonds. And you're sitting there thinking, cool, but what does that actually mean? Should I buy a house now? Is this going to last? And why can the government just do that? Here's the thing. This single decision could save you literally hundreds of thousands of dollars over the life of a mortgage. Or it could be a temporary blip that disappears in 3 weeks. And which one it is depends on understanding how this whole system actually works. I spend way too much time thinking about how government policy affects your actual wallet. If you're someone who's been trying to figure out when to buy a house, or you're just completely confused about why mortgage rates do what they do and how the government is suddenly involved, make sure to hit that subscribe button and give this video a thumbs up if this helps you out. Okay, so let's start with what actually happened, because the headlines make this sound way simpler than it actually is. The Trump administration just directed Fannie Mae and Freddie Mac, which are these weird government-sponsored enterprises that we'll explain in a minute, to purchase up to $200 billion worth of mortgage-backed securities. And almost immediately, mortgage rates dropped from around 6.8% to below 6%. Now you might be thinking, that's great. Lower rates mean I can afford a house now. And maybe. But here's what most people don't realize. This is way more complicated than government does thing, rates go down, everyone wins. Let me explain why. Look, I know the term mortgage-backed securities makes your eyes glaze over, but stay with me, because understanding this is the difference between making a smart housing decision and making a $300,000 mistake. Here's how it works. When you go to a bank and get a mortgage, you probably assume that bank is going to hold on to your loan for the next 30 years. Right? You send them a payment every month, they collect the interest, everyone's happy. But that's not what happens. What actually happens is the bank turns around and sells your mortgage, usually within like 30 days, to investors. They bundle a bunch of mortgages together into what's called a mortgage-backed security, and then investors buy these bundles. Why would investors want to buy a bundle of your mortgage and thousands of other people's mortgages? Because you're paying interest every month, which means steady, predictable returns. Now here's where Fannie Mae and Freddie Mac come in. These are government-sponsored enterprises. They're not technically part of the government, but they're not really private companies either. They exist in this weird middle zone, and their job is to buy mortgages from banks, bundle them into securities, and sell them to investors. Why does this matter? Because when Fannie and Freddie buy a lot of mortgages, it gives banks more money to lend out as new mortgages. More supply of available mortgages means lower rates for you. It's basic supply and demand, but for debt. According to the Mortgage Bankers Association, about 70% of all new mortgages in America eventually end up being backed by Fannie Mae or Freddie Mac. So these organizations basically are the mortgage market. Okay, so here's what the Trump administration just did. They directed Fannie Mae and Freddie Mac to buy $200 billion worth of mortgage-backed securities from the open market, not create new mortgages, buy existing mortgage bonds from investors who currently hold them. Now, why would this lower mortgage rates? Here's the thing. Mortgage rates are determined by what investors are willing to pay for mortgage-backed securities. If investors are lining up to buy these securities, rates go down. If investors are avoiding them, rates go up. It's the same logic as any market. High demand, shout higher prices, shout lower yields, shout lower mortgage rates. So when the government says, hey, we're about to buy $200 billion worth of these things, it sends a signal to the market that demand is about to spike. Other investors see this and think, oh, if the government's buying, maybe I should buy too. This increased demand drives up the price of mortgage-backed securities, which mathematically means the yield goes down, which means mortgage rates go down. I know that sounds backwards, but here's a simple way to think about it. Let's say I have a bond that pays $1,000 per year. If you buy that bond from me for $10,000, your return is 10%. But if you buy it for $20,000, your return is only 5%. Same $1,000 payment, but the more you pay for the bond, the lower your return. That's what's happening here. The government buying $200 billion worth of mortgage bonds drives up the price, which drives down the yield, which drives down mortgage rates. So mortgage rates dropped below 6% for the first time in 3 years. Let me show you what that actually means in real dollars, because this is where it gets really interesting. Let's say you're buying a $400,000 house with 20% down. That means you're financing $320,000. At a 6.8% interest rate, your monthly payment is about $2,088. Over 30 years, you'll pay about $431,780 in interest alone. At a 5.9% interest rate,
Your monthly payment drops to $1,896. Over 30 years, you'll pay about $362,560 in interest. That's a difference of $192 per month, or $69,120 over the life of the loan. For context, that's more than a year's salary for the median American worker, just from a 0.9% difference in interest rates. So yeah, this matters. And this is but here's what nobody's talking about in all these headlines. This might not last. Look, I want cheaper mortgages as much as anyone. But we need to talk about the potential problems here because they're significant. Here's the thing about announcing you're going to buy $200 billion of anything. The market reacts immediately to the announcement, not to the actual buying. We've already seen rates drop just from the news. But what happens when Fannie and Freddie actually start buying? What happens when they stop? There's a real risk that this is just a temporary spike in demand that drives rates down for a few weeks or months, and then rates climb right back up when the buying ends. We actually saw this exact pattern during the 2008 financial crisis. The Federal Reserve bought trillions of dollars in mortgage-backed securities to keep rates low. It worked while they were buying. But every time they even hinted at stopping, rates spiked. So if you're thinking about buying a house because rates dropped to 5.9%, you need to understand that you might be locking in that rate, but your neighbor who buys 6 months from now might be back to 7% or higher. Now you might be thinking, why is that a problem? I lock in a low rate. That's good for me. And sure, if you're buying right now. But here's the second order effect that most people don't think about. Lower mortgage rates mean higher buying power, which means more demand for houses, which means higher home prices. Let me show you what I mean. Let's say you've decided you can afford a $2,000 monthly mortgage payment. At a 7% interest rate, that means you can afford a house worth about $343,000 with 20% down. But at a 5.9% rate, that same $2,000 payment means you can afford a house worth about $382,000. That's $39,000 more in purchasing power from the rate drop alone. Now multiply that across every buyer in America. Suddenly everyone can afford to pay more, so sellers raise their prices. We saw this exact phenomenon in 2020, 2021. The Fed dropped rates to near zero, everyone's purchasing power went up, and home prices increased by an average of 19% in a single year according to the Case-Shiller Home Price Index. So yes, you get a lower rate, but you're paying that lower rate on a higher price. And depending on how much prices increase, you might actually end up worse off. Okay, this one's a bit more abstract, but it matters. Here's the thing. When the government steps in to manipulate markets, which is what this is, let's be clear, it creates what economists call moral hazard. Basically, if investors know the government will step in to buy mortgage bonds whenever rates get too high, they have less incentive to buy those bonds themselves at fair market prices. Why would I, as an investor, buy mortgage bonds at a 6% yield if I think the government's going to step in and drive yields down to 5.5%? I'll just wait for the government to pump up the price and then sell to them. This creates a market that's increasingly dependent on government intervention to function. And that's a problem because government intervention is A, expensive. This is taxpayer money being used. B, politically motivated. It'll happen more before elections and less after. C, unsustainable. You can't manipulate markets forever without consequences. We've seen this pattern in Japan where the central bank has been buying bonds for so long that the entire bond market is basically non-functional without government support. Okay, so enough doom and gloom. Let's talk about what you should actually do with this information. If you're in the market for a house right now, here's my take. If you were already planning to buy in the next 6 months, this rate drop is genuinely good news for you. Lock in a rate as soon as you find a house you want. Don't wait around hoping rates will drop even further, because they might not. Get pre-approved now while rates are below 6%, and that gives you a rate lock for typically 60-90 days depending on your lender. If you were on the fence about buying, don't let this rate drop pressure you into a decision you're not ready for. Yes, 5.9% is better than 6.8%, but it's still historically a pretty high rate. The average mortgage rate from 2010-2020 was about 4.3%. And remember what we talked about, lower rates might be offset by higher home prices. You need to run the math on the actual house you're considering, not just react to the headline rate. Here's a simple test. If this rate drop is the only reason you're considering buying, you're not ready to buy. If you were ready to buy anyway and this makes it more affordable, go for it. If you currently have a mortgage above 6%, start looking into refinancing immediately. If you can drop your rate by even 0.5%, it's probably worth the refinancing costs. Run the numbers with a refinance calculator. You want to make sure you'll stay in the house long enough to recoup the closing costs. For context, refinancing typically costs about 2 to 3% of your loan amount. So on a $300,000 loan, you're looking at $6,000, $9,000 in costs. If refinancing saves you $200 per month, you'll break even in 30, 45 months. If you're planning to stay in the house longer than that, it's probably worth it. Look, here's what really frustrates me about how this whole thing is being covered. Everyone's focusing on whether this is good policy or bad policy, whether Trump is smart or dumb, whether this will help or hurt, but almost nobody is talking about why we're in this situation in the first place. We have a housing market that's completely dysfunctional. Home prices have increased by over 47% since 2019, according to the Case-Shiller Index, while median wages have increased by only about 17%. That's not sustainable math. And instead of addressing the actual problems, restrictive zoning laws, shortage of housing supply, labor shortages in construction, increasing material costs, we're trying to solve it by manipulating interest rates. It's like if your car's engine was broken and instead of fixing the engine, you just kept adding more gas to try to make it go faster. Eventually, you're going to blow the whole thing up. Here's what most people don't realize. Cheap mortgage rates are not the same thing as affordable housing. If rates are at 3% but houses cost $800,000, that's not more affordable than rates at 6% and houses costing $400,000. You're still paying $800,000 for the house, you're just doing it with cheaper borrowed money. And here's the really insidious part. Cheaper borrowed money encourages people to borrow more, which drives prices even higher, which makes housing less affordable even with the lower rates. We saw this exact cycle from 2002-2007, and we all know how that ended. So here's the question that actually matters, and it's not, should I buy a house because rates dropped? The real question is, can I afford this house if rates go back up and I need to move in 5 years? Because here's the thing, if you buy a house with a 5.9% mortgage right now, that's great. But if you need to sell in 5 years and rates are back at 7%, the person buying from you is going to have way less purchasing power than you did, which means either they can't afford to pay what you paid or home prices have increased enough to offset their higher rate. And if it's the first option, you're going to take a loss or be stuck in a house you need to leave. This is called interest rate risk, and almost nobody thinks about it when they're buying. A study from the National Association of Realtors found that the average homeowner stays in their home for about 13 years. But if you're in your 20s or 30s, that number drops to about 7-8 years. So you need to be thinking about not just, can I afford the payment, but what happens to the value of this asset if the market conditions change? All right, so here's what I think is the smart play, regardless of what happens with rates. Focus on the total cost, not the monthly payment. Lenders love to talk about monthly payments because it makes expensive things sound affordable. You can buy this $500,000 house for only $2,400 a month, but that's not the right way to think about it. You need to look at the total purchase price, total interest paid over the life of the loan, opportunity cost of your down payment, and maintenance, insurance, taxes, and other costs. Run the full 30-year math. If you're going to pay $400,000 in interest on a $350,000 house, that house actually cost you $750,000 plus your down payment. Is it worth $750,000? That's the real question. Get multiple rate quotes before locking. Here's something that blows my mind. According to Freddie Mac's own research, about 50% of borrowers don't shop around for mortgage rates. They just take whatever their bank offers or whatever the first lender they talk to gives them. And the difference between the best and worst rate offers for the same borrower can be 0.5% or more. On a $300,000 loan, that's about $90 per month or $32 to $400 over the life of the loan. You need to get quotes from at least 3 to 5 lenders. It takes maybe 2 hours of your time and can save you tens of thousands of dollars. Don't stretch your budget just because rates dropped. This is the big one. Just because you can afford a $2,500 monthly payment at 5.9% doesn't mean you should. The general rule is your total housing costs, mortgage, insurance, taxes, maintenance should be no more than 28% of your gross income. But here's the thing, that's a maximum, not a target. If you can comfortably buy a house where your payment is 20% or 22% of your gross income, that gives you way more flexibility for when life happens. Because life will happen. You'll lose a job, or have a medical emergency, or have kids, or want to change careers. And if you're stretched to the absolute maximum of what you can afford, you have zero room for error. Build in a rate buffer. Here's something smart buyers do that most people don't. Even if you can get a 5.9% rate, run the numbers at 7% or 7.5%. If the higher rate makes the house unaffordable, you're buying too much house. Why? Because even though you're locking in your rate, everything else about your housing costs can change. Property taxes can increase. Insurance can spike, which we've seen massively in the last few years. HOA fees can go up. If you're already maxed out at the current rate, any increase in these other costs is going to hurt. Okay, so let's talk about timing, because this is what everyone actually wants to know. Should I buy now or wait? And look, I can't tell you specifically what to do because everyone's situation is different. But here's the framework. If rates are the only thing you're waiting for, you might be waiting forever. Trying to time the mortgage rate market is like trying to time the stock market. Yeah, theoretically you could get lucky and buy at the perfect moment, but you're way more likely to either buy too early and miss a better rate, or wait too long and miss the opportunity entirely. According to the data we have, this $200 billion purchase program is expected to roll out over the next 12-18 months. So we might see rates stay relatively low during that period, but, and this is important, we might also see home prices increase during that period, which could offset any rate advantage. Here's my take. If you find a house you genuinely want to live in a location that makes sense for your life, at a price you can afford without stretching, and you plan to stay there for at least 7 to 10 years, buy it. The rate matters less than those other factors. But if you're trying to buy because you're afraid of missing out, or because everyone says rates are going up, or because you think houses are an investment that only go up, don't. Those are bad reasons to make the biggest financial decision of your life. Now let's talk about the elephant in the room that affects half of Americans. What if you're renting and you're trying to decide if this changes the rent versus buy equation? Here's the uncomfortable truth. For a lot of people, especially in high-cost areas, renting is still the smarter financial move, even with rates at 5.9%. I know that's not what you want to hear. I know the cultural narrative is renting is throwing money away and you need to build equity. But here's the thing. If you're in a city where homes cost $600,000 and you can rent a comparable place for $2,000 per month, the math of buying doesn't work. Let me show you. A $600,000 house with 20% down means a $480,000 mortgage. At 5.9%, that's $2,133 per month in principal and interest alone. Add in property taxes, let's say $6,000 a year, insurance, let's say $1,500 a year, and maintenance, 1% of home value annually, and you're looking at about $3,858 per month in total housing costs. Compare that to $2,000 in rent, that's a $1,958 difference every single month. But when you rent, you're not building equity. Okay, but what if you invested that $1,958 difference every month in an index fund averaging 10% returns? In 30 years, you'd have about $397 million. In that same 30 years, your $600,000 house might be worth $1.5 million, assuming 3% annual appreciation. Subtract the roughly $369,000 you paid in interest over 30 years, and your actual gain is way less than the renter who invested the difference. Now, I'm not saying renting is always better. I'm saying you need to run your specific numbers for your specific market. This is where it gets really interesting. Lower mortgage rates make buying more attractive relative to renting, but only if home prices don't increase to offset that advantage. So keep an eye on both numbers, not just rates, but actual home prices in your area. Look, here's the bottom line. The Trump administration's $200 billion mortgage bond purchase plan is real, and it's already having an effect on rates. That's good news if you're in the market to buy or refinance. But don't let a headline about dropping rates pressure you into the biggest financial decision of your life. Lower rates are great, but they're not everything. You still need to buy a house you can actually afford, in a location that makes sense for your life, that you plan to stay in long enough to make the transaction costs worth it. Don't buy a house because rates dropped. Buy a house because it's the right move for you financially and personally, and the rate drop just makes it a bit more affordable. And if you're sitting here thinking, I can't afford a house even with lower rates, that's okay. You're not behind. Focus on increasing your income, saving for a down payment, and improving your financial position. The housing market will still be there when you're ready. So here's what I want you to do. If you're seriously considering buying in the next 6 to 12 months, get pre-approved right now. It costs you nothing. It locks in your rate for 60, 90 days, and it shows you exactly what you can actually afford. If you currently have a mortgage above 6.5%, talk to a lender about refinancing. Run the numbers. See if it makes sense. And if you're just trying to understand what's happening in the market, keep watching videos like this, because understanding how these systems work is how you avoid making $300,000 mistakes. If this video helped you understand what's actually happening with mortgage rates and what it means for you, hit that like button and subscribe, because I break down complex financial news like this every single week. And drop a comment. Are you planning to buy a house in the next year? Are you waiting for rates to drop more? Or do you think the whole housing market is broken? I genuinely want to hear your thoughts. Thanks for watching, and I'll see you in the next one.